Good morning, ladies and gentlemen. It's my pleasure to welcome you here at Czech National Bank again. I would like to open the first meeting with analysts of this year. The session follows yesterday's monetary meeting of the Czech National Bank Board. As usual, our meeting will start with the presentation of the new macroeconomic forecast, which was the basis for yesterday's decision to raise interest rates by 25 basis points. The second part will be discussion. First of all, please let me introduce the speakers of today. The CNB Bank Board is represented by Mr. Vojtěch Benda, sitting next to me. And the other speaker is Mr. Petr Král, Executive Director of the Monetary Department. Mr. Král will now present you the details of the new macroeconomic forecast. Mr. Král, the floor is yours.
Thank you for the floor. Good morning, ladies and gentlemen, dear colleagues. It is my great pleasure to be here again, delivering this presentation on CNB's new quarterly macroeconomic forecast. The structure of my presentation will be such as follows. First, I would like to introduce the assumptions on which the new forecast is based. After that, I will provide you with an in-depth insight into the story and the quantitative dimension of the new forecast. Next part of my presentation will be dedicated to a brief comparison of the new forecast with the previous one, paying special attention to the composition of the forecast change in terms of interest rate outlook and inflation outlook vis-à-vis the previous prediction. And final part of my presentation will be dedicated to the exchange rate sensitivity scenario, which nicely illustrated the considerations we had during the preparation of the forecast, having seen the relative stability of the exchange rate over the last couple of quarters based on the heightened global negative sentiment with some correction of the exchange rate in recent weeks and months, with some possible implications for the future. As for the external environment outlook, we can claim that based on the latest available hard data, looking at high-frequency indicators and soft data, and having at our disposal our own near-term forecasting technique, so we can claim that the euro area has just been going most likely around the trough of the growth cycle, and we can expect that GDP growth in the countries of our major trading partners will gradually accelerate in the quarters to come. Being driven by this economic weakness, the PPI growth in the effective euro area has just stopped, being driven by both its energy and core component, but following the expected acceleration of the recovery of the economic growth, also PPI growth should also start with the primary contributions of the core segment, but also the energy segment will be delivering some positive contributions following the previous increase in crude oil prices. As you know, financial markets do not expect any more further loosening of monetary policy from the ECB, and that's why the market outlook has shifted somewhat upwards compared to the previous forecast, to the assumptions of our previous forecast. But despite this, the 3M Euribor outlook is still quite deeply in a negative territory, and we can expect only mild increase still within this negative territory at the end of a forecasting horizon. Nothing has changed since last forecast as regards the quantitative easing program or the unconventional monetary policy measure of the ECB. That's why we still work with this shadow rate component representing the effects of this asset purchasing program, and this shadow rate has also shifted a little bit upwards in parallel with the headline 3-month Euribor, following the ECB's communication and following the fact that the Eurozone is probably bottoming out in the near future. Despite this, we can expect that consumer price inflation in the effective euro area will stay somewhat below 2% over the whole forecast horizon, and we can expect that the euro will appreciate only slightly against the dollar in the coming quarters. As for the domestic assumptions, the principal role is given to the fiscal policy. After being in slight deficit, in slight surpluses in recent years, the general government balance will turn to be moderately negative at the end of forecasting horizon, which is 2021. So the cyclical position of the economy, together with some fiscal discretionary measures, will gradually close the surpluses, and the budget balance will open to negative territory, to slightly negative territory in 2021. For the forecast as such, it is more important to the assumption that the real government consumption will be still growing quite significantly, providing growth stimulus to the overall domestic demand and GDP growth. This government consumption growth will be driven by ongoing solid increases in public sector pay, but also the non-wage component of real government, such as current expenditures and natural social transfers and transfers in kind, and especially healthcare expenditures will also contribute quite significantly. And as you know, the government has recently approved some further measures to stimulate private consumption in the form of some extra increase in old age pensions going beyond the standard indexation formula. They have approved the increase in parental benefit, and all these things together will somewhat stimulate private consumption growth in 2020. But all in all, the effect of fiscal policy will be close to neutral in both 2020 and 2021, as you can see in this table featuring the fiscal impulse figures. So the marginally positive fiscal impulse of 0.1 percentage point during this year will be driven by these private consumption stimulating measures, whereas the marginally negative fiscal impulse can be expected in 2021. But as I mentioned, those are contributions beyond the stimulating effects of real consumption, real government consumption growth, which is per se demand component of GDP. Let me now turn your attention to the actual macro forecast picture. As you know, inflation has gone up in the last month of last year, reaching the upper boundary of our tolerance band. The pickup of inflation rate in recent months have been driven by further acceleration of food price growth and administered price growth, and the ongoing robust contribution to the price growth has been generated by very stable, robust core inflation. We expect that inflation will, in the coming quarters, increase further and will be somewhat above the upper boundary of our tolerance band for the almost rest of this year, and will decline to the proximity of the target in the second half of next year. Here you can see that part of this increase of the inflation rate in the coming quarters will be generated by expected impacts of changes to indirect taxes, as we have a lot of government measures to have been approved in the past and to have been taking effect as from January this year. So you can see that the deviation of the monetary policy relevant inflation from the headline inflation is quite significant on the whole forecasting horizon. So the monetary policy relevant inflation is somewhat lower compared to the headline inflation, and the monetary policy relevant inflation is getting to the target at the monetary policy horizon, which is the first half of next year, being supported by the further tightening of domestic monetary conditions at the beginning of this year. Here you can see the graph representing the estimated effects of indirect tax changes. As in the previous forecast, we have implemented the rises of excise duties on tobacco products as from January this year, together with the fact that in connection with the launch of third and fourth phase of the electronic sales registration, some CPI components, especially services, will be let's say reclassified from the basic VAT rate to the reduced VAT rate, which will happen as from May this year, and we expect that this indirect tax decrease will not be fully transmitted into the prices of the individual components. That's why we expect some non-negligible secondary effect of this VAT change. But this is fully in line with what we had in the previous forecast. What is new in this graph is the another phase of or another increase of excise duties on tobacco products effective as from January next year, which has some primary effects of approximately 0.2 to 0.3 percentage points as from January next year, without any secondary effects and without any impact on monetary policy relevant inflation in those months and quarters during next year. Let's have a closer look at the expected inflation and inflation components in the months to come. As I mentioned, we can expect that in the coming months, inflation will accelerate quite significantly above the upper boundary of our 2% inflation target, which is above 3%, and the peak could be somewhere in April at around 3.7%, which will be driven by, as I mentioned, the effects of indirect tax changes, the increase in excise duties, together with some further short-term acceleration of food price growth being supported in year-on-year terms by base effect from last year, which is especially significant in April. We can also expect that the core inflation will, in the coming months, be roughly stable at the current still elevated level, and following the expected positive secondary round effects of VAT change, we can expect some further mild acceleration of this component following May and June. That's probably it. On the last row, you can see that monetary policy inflation will be much closer to the upper boundary of the tolerance band than the headline inflation because of these excise duties increases. As for the individual components of inflation in the longer-term perspective, we can expect for the core inflation to be roughly stable during this year, being, as from May, slightly supported by the secondary effects of VAT change. But after that, the fundamental inflation pressures from the domestic economy will be gradually fading away, and the core inflation will be coming down during next year. Food price growth, which has been quite sharp in recent months, being driven not only by supply-side factors such as poor harvest of certain items of vegetable food and, for example, potatoes following the hot and dry weather during the last season, is also fueled by very strong domestic inflation pressures, which stem not only from the continuous growth in continuing cost growth, but the food price inflation is also supported by still very optimistic and very strong demand-side pressures, and by increases in profit margin of food price producers and retailers. But after the domestic fundamental pressures will gradually moderate, we can also expect in this segment some deceleration of price growth, and this deceleration will be supported by the current and expected decline in world agricultural commodity prices and domestic producer prices. The regulate price growth has also been quite sharp in recent quarters, and we are now just, let's say, around the peak of its growth rate, and we can expect that regulate price growth will quite sharply decelerate in the coming months and quarters, as the primary driver, which has been so far the increases in electricity prices for households, will gradually accelerate. But compared to the previous forecast, in this particular component, there is an upward revision, and you can find it in the backup slides. There is an upward revision following the fact that the price increases of electricity will be somewhat higher compared to the previous forecast, and due to the fact that the expected decreases of natural gas for households will be somewhat less pronounced. As for the fuel prices, we can expect that those will be most of the time declining, slightly declining, with the exception of the very beginning of the forecast horizon, where there is a mild year-on-year increase following the previous crude oil price increases. Let's have a look on the domestic inflation fundamentals, domestic inflation pressures, or the overall domestic pressures. In the upper chart, you can see that the growth rate of total costs in consumer sector will be stable around 2% over the whole forecast horizon, with the domestic economy contributing still most significantly to the overall growth, whereas the import price component has started to generate some negative contribution following the slightly declining foreign prices. But as we expect some recovery in foreign price growth, and as we expect roughly stable exchange rate of the koruna against the euro over the next couple of quarters, we can expect that this import price contribution will also be moving from negative territory to some mildly positive contribution. As for the domestic inflation pressures as such, we all know that there was some tendency of these pressures to decrease over time, but at the beginning of this year there is, let's say, temporary increase, temporary reversal of the previous trend because of the new measures of the government measures stimulating consumption growth, among which we compute the further significant increase in the minimum wage, the further extraordinary increase in old age pensions going beyond the standard indexation formula, and the introduction or the increase in parental benefit. So the contribution of the wage growth and the contribution of price of capital reflecting these stimulating measures will cause that the overall domestic pressure pattern will go up slightly at the beginning of this year, but in the rest of the horizon there will be mildly declining tendency, following especially the estimate of following the mildly decelerating nominal wage growth in business sector. As for the GDP outlook, we start with the fact that GDP growth of Czech economy has declined in the second half of last year, following the economic downturn or slight economic deceleration in the countries of our major trading partners. But following the assumption that we can expect some recovery in foreign demand growth, also domestic economic growth will recover or will accelerate back and will reach almost 3% in 2021, with household consumption and government consumption still being the primary drivers of this continuing economic growth. And more lately, also the private investment and net export will make a positive contribution to this slightly accelerating GDP growth. Here you can see this when looking at individual demand side components. As I mentioned, the household consumption growth is still relatively robust, following the prevailing tightness on the labor market and being promoted by those government measures stimulating consumption growth. Fixed investment that have stopped growing in private sector in recent quarters, as the firms were facing the negative sentiment from abroad and the slight decline in demand for the exports. Those investments will recover in the coming quarters as the picture about the foreign economic prospect is getting gradually better. And recovery in this private investment growth will join the ongoing solid growth in public investment, which is also supported by the project co-finance from the EU funds, as we are approaching the end of the current programming period, and the Czech authorities try to do their best to spend as much money from the EU funds as possible. In the other chart, we can expect that export has just stopped growing as the foreign demand weakness was somewhat hitting our small, open, very export-oriented economy. But we can expect a relatively sharp recovery in the export performance, and the export growth will accelerate to its almost steady state levels in the second half of the forecasting horizon. This acceleration of export growth will be partly promoted also by the fact that with the expected recovery in foreign producer price growth, this will be delivering some pro-growth stimulus via increased price competitiveness of Czech exporters vis-à-vis their counterparts in the euro area. And import growth is a natural reflection of the profile in export performance and in the profile of domestic demand, with special role being played by private investment, which is very import sensitive or import penetrated domestic demand component. The situation on the labor market is still very tight, despite the fact that we have probably reached the peak of this tightness in recent quarters. That's why we cannot expect any further increases of total employment in the coming quarters, and employment growth will be slightly negative in the coming quarters, or being roughly close to zero in the more distant future. That's why also the unemployment rate will remain close to its very low levels over the whole forecast horizon. Growth in market sector wages has been decelerating over time, and this deceleration will continue. But this pace of deceleration will be somewhat moderated by the fact that the government decided to further increase the minimum wage as from January this year by approximately 10%, which has some effects on overall wage growth in business sector of approximately 0.2 percentage points. And we can also expect that still very robust growth in public sector pay will also prevail on the forecasting horizon, and after some initial heightened volatility being driven by the base effects, the growth rate of wages and salaries in the public sector will stabilize somewhere slightly above the market sector's pace. After being very stable during 2018 and 19, the Koruna exchange rate appreciated somewhat at the end of last year and in the first weeks of this year. The near-term forecast for the exchange rate is set at 25.3 koruna per euros. In the baseline, we interpret this recent move of the exchange rate as being kind of short-lived phenomenon, and the fundamentals that curbed the exchange rate appreciation during the last 2 years are still in place. By those factors, I mean the heightened global negative sentiment and the still very low foreign economic and price growth. So these effects will be curbing the potential appreciation of the exchange rate in the quarters to come. The potential for appreciation is here given by the very heightened or very wide interest rate differential with the euro area, and by the fact that the Czech economy is still successfully going through the real convergence process, and the real equilibrium appreciation of the currency is a natural feature of that process. But as I mentioned, the curbing effects are still in place, and that's why the koruna will be roughly flat during the whole this year, and will be only mildly appreciating in 2021. Consistent with our new forecast is an initial rise in domestic market interest rates, followed by their decline as from the second half of this year. The initial increase in domestic interest rates is driven by persistently heightened domestic inflationary pressures, which have some potential to influence the inflation outlook on the monetary policy horizon. And those pressures, those fundamental domestic pressures, will be further supported by the government measures approved to further stimulate domestic consumption or household consumption. And also those second round effects of VAT change will also influence inflation in the rest of this year and at the beginning of next year. The subsequent decline in the interest rate trajectory is attributable to the fact that we expect that those domestic inflation pressures will be gradually fading away, and that we will be still influenced by the very accommodative monetary policy of the ECB, having still their statutory nominal interest rates in negative territory and still conducting unconventional monetary policy. Let me now briefly compare the new forecast with the previous one. The CPI outlook has been revised upwards quite significantly, especially in the first few quarters. This has been driven by the expected higher growth in administered prices, together with some more inflationary pressures being identified at the initial condition of the forecast. And for the headline inflation, it is also important that we incorporated the expected further increase in excise duties on tobacco products for 2021. Unlike the GDP growth forecast hasn't been changed much, as you can see in the respective chart. As for the wage outlook, we were somewhat surprised on the downside by the market sector wage growth for the third quarter of last year compared to what the previous forecast anticipated, and this is leading the profile. This is explaining the mild downward shift in the forecast in the first couple of quarters. But in the medium term, or in the more distant future, there will be an effect of inflation being higher for longer in the Czech Republic compared to the previous forecast, which has some effects via price expectations and wage negotiations on the expected nominal wage growth in the business sector. That's why the longer part of the horizon, there is some mild, some upward revision of the wage forecast. As for the exchange rate outlook, the koruna appreciated somewhat in recent weeks, which was not fully anticipated by the previous forecast. But as I mentioned, we identify this, or we consider this koruna movement as being non-fundamentally driven, and that's why the whole path of the exchange rate hasn't been changed much. So from this somewhat stronger levels, we will be appreciating more mildly compared to the previous forecast. And for this year, this means some rough stability of the exchange rate. As for the interest rate outlook, the path has been revised relatively mildly, with some marginal downward revision for the next couple of quarters, and with some upward revision at the more distant future. The drivers of the initial downward revisions are especially such as follows. The initial conditions, which is the undelivered interest rate hike, which was envisaged or forecasted by the previous forecast, together with some smaller wage growth in the second half of last year, which I was just explaining. So the initial conditions are making some contribution in negative territory. The stronger than expected exchange rate is making the contribution in the same direction. The opposite effects stem especially from foreign environment. As I mentioned at the beginning, the foreign interest rate outlook has been revised somewhat upwards following the ECB's change in communication in recent months compared to the assumptions of the previous forecast. The regulated price growth has been also the outlook for regulated price growth has been also revised upwards, making some contribution in this sense. And the expert judgments are also making some positive contribution following the fact that the new forecast incorporated the increase in the parental benefit, and we also incorporated the final decision of the government to increase the minimum wage by approximately 10%, whereas the previous forecast was expecting roughly half of that increase to be in place. So we now have more precise information, both about the exact figure and simultaneously about the actual impact on the overall wage growth. And here you can see the decomposition of the monetary policy relevant inflation forecast. So this is monetary policy relevant inflation. So those excise duties changes are not part of this picture because they do not enter monetary policy relevant inflation. Here you can see that the upward revision is driven primarily by the initial conditions, which is again the undelivered previous interest rate hike, which was envisaged by the last forecast, together with the upward revision of foreign outlook, especially by the upward revision of Euribor trajectory and by the somewhat higher crude oil prices in this forecast compared to the assumptions of the previous one. Also, the expert judgments are playing the role in the same direction, and those are the measures I have already mentioned several times today. The stronger koruna exchange rate is having some dampening effect on this change in the expected inflation outlook, as the initial condition of the exchange rate is somewhat stronger compared to what the previous forecast anticipated. And now let me turn your attention to some considerations we had during the preparatory works on our new forecast. As you know, the koruna was very stable over 2018 and 2019, and we were sometimes surprised by this stability of the exchange rate in the environment when our interest rates were going up and the inflation and the interest rate differential was opening, and the country was growing quite significantly, and there was some potential for a real convergence process to be in place. So we were asking ourselves to what extent those long-term fundamentals are somewhat distorted by some extra phenomenon, we realized that there is some curbing effect stemming from the negative global financial sentiment, which was more lately supported by the actual economic deceleration in the euro area and some deceleration of or the disinflation process in the euro area, which in our model has the tendency to curb koruna appreciation. And the global phenomenon has been incorporated into the forecast by the increase of the persistent part of country risk premium within the UIP equation, within the exchange rate equation. And this heightened persistent country risk premium is in the forecast and has been also in the previous forecast still in place, but it should gradually decelerate over time, so having still some curbing effect, but this curbing effect will gradually weaken over time. That's why the previous two forecasts predicted only mild koruna appreciation, and this is also the case of the new baseline. We still think that those negative effects, these effects of the negative sentiment, will be, let's say, limit the potential for koruna to appreciate. But we were asking ourselves, what if the curbing effect of this negative sentiment would disappear completely and suddenly? So what is the actual effect of this curbing effect? What is the actual magnitude of this curbing effect when looking at the domestic exchange rate and other variables? And that's why we prepared this exchange rate sensitivity scenario, in which, unlike the baseline, we skipped, or we dropped the negative sentiment from the UIP equation. So in this scenario, the interest rate differential and other domestic fundamentals that would predict koruna appreciation are functioning the same way we were used to some time ago. So in this scenario, the koruna is now exposed to very wide interest rate differential in the economy, which is generating some current account surpluses, etc., etc. So in this scenario, the exchange rate is suddenly under very huge underlying pressure to appreciate. This appreciation, if happened, could undermine the ability of the central bank to fulfill inflation on the forecasting horizon, which the central bank cannot afford or cannot tolerate. That's why the reaction of domestic interest rates to compensate these underlying strong appreciation pressures is such that the interest rates are not increasing anymore, but after some short period of stability, they start to decrease. So they need to close the interest rate differential as quickly as possible, not to open the floor for the exchange rate appreciation. By closing this interest rate differential, the final outcome of this scenario is that the exchange rate is only mildly stronger than in the baseline scenario. But the underlying pressure on the appreciation is much stronger, but it is not directly visible in the exchange rate trajectory, but is visible in the interest rate profile. So if we lived in a world where the negative sentiment is completely away and everything concerning the cross-border financial flows and arbitrage, etc., is functioning as nicely as it used to in the more distant past, then the exchange rate would get into under such a strong pressure, which would need some counter-reaction from the central bank. The counter-reaction in this scenario is successful. The exchange rate is not appreciating that much. That's why the CPI on the monetary policy horizon is only marginally below the baseline, and the GDP outlook is has not been changed much from the baseline. But this is another piece of showing you that the exchange rate and the exchange rate pass-through is not a deep parameter of the economy, because here you can see quite mild deviation of the exchange rate from the baseline, but the very big deviation of the interest rates. So when comparing this exchange rate sensitivity scenario with, for example, standard plus minus 3% exchange rate scenario, which is a short-lived, non-fundamental type of shock, here you can get a completely different picture because of the fact that the driving force of this exchange rate movement and deviation from the baseline is something fundamental, is that the complete disappearance of global negative sentiment. Just to remind you, we are in the baseline scenario convinced that this is not that the baseline is the baseline. This is just the illustration of the fact how big a role the negative sentiment have played in the recent past, and how it is also is influencing the outlook for both exchange and interest rates for the next couple of quarters. Ladies and gentlemen, having said that, I would like to thank you for your attention now, and I'm returning the floor back to Petra.
Thank you, Mr. Kral, for your presentation. Now it's time for the debate. Before we start, I would like to ask you to introduce yourself and your institution. It's important for others who are watching us online. So the first question is on you. Who would like to start? Mr. Sobíšek.
Hello, Pavel Sobíšek, UniCredit Bank. My question is, there must have been two MPC members who last time voted for the rates to stay unchanged, while now they decided to raise their hand in favor of a hike. I would like to know what was, in your view, Mr. Benda, a swing argument for them, because it is not quite clear from the analysis if there is something more fundamental, or whether it is just the fact that we are experiencing now the spike in inflation, which would fade away even without this hike. Thank you.
Thank you, Paul, for your question. So, first, allow me a short promo, because next Friday we will publish for the first time attributed minutes. So you will see not only the voting of the particular board members by names, but also you will see the attributed comments during the debate. Of course, it's something new for us as well, because we had already some shadow trial in the previous couple of meetings, at 2-3 meetings we had, and it's like a fun, because of course we are sometimes debating. That's what I said as well, but I'm not mentioned there. So it's something new for us as well, but you will have opportunity to see how, in fact, in time, the opinion developed in cases of each particular board members. What changed mind of two other board members and joined the, as you call, you analyst, the hawkish camp? It's difficult to say, because I'm not a deep mind psychologist, but I think that one of the main reasons was that the development of the external sector. And when I look back to August 2019, when we, in fact, unanimously voted for no change in interest rates. There was a big uncertainty which direction the foreign economy or global economy is going to go. There was one possibility that the economy will dive into the deep recession, especially in the Eurozone, and the other possibility was some kind of soft patch and some gradual recovery over 2020. And I think what changed over the last 6-7 months is that it seems that especially the Eurozone economy, it's not really booming, but it was prevented from a deep recession. And so the external sector doesn't represent an imminent threat for the anti-inflationary pressures for the economy. And this is maybe the soft game changer in the thinking on the assessing of the arguments whether to vote for a no change or an increase of interest rates. But fairly said, the debate about increasing or no change was on the table during the all previous meeting we experienced. So probably this time it was a soft the balance of the anti and pro-inflationary risks tilted softly to the pro-inflationary, mainly due to the soft reassessment of the external environment. Maybe one more thing. I think not only for us, but also for you, we were expecting the increase of inflation, but the increase of inflation was surprising even for us to some extent, mainly in terms of food prices and some core inflation. So this also played a role because, as you said, as you saw in the presentation by Petr Král, the initial conditions were very influenced by the initial state on inflation we were observing during the previous months. And this is also something that played a role in the decision making or in the debate during the meeting of the board members.
Thank you, Mr. Benda. Next is Mr. Seidler.
Jakub Seidler, ING Bank. If the further development will continue as the baseline project, do you see likely the scenario of basically cuts in the second half of the year, in your personal opinion? Or maybe what was the discussion of the board about the relatively soon cuts expected in the forecast? Thank you.
Thank you, Jakub, for your question. There's always the debate whether to smooth further, already smoothed interest rate path. And yes, you mentioned there was a projected hike and there is some cut thereafter. Actually, this is something that is only indicative, but it's not binding. It's not obligatory for the board to follow completely the path. And the monetary policy recommendation for the last meeting was only for the set of the interest rate now or yesterday for the next period. And what will be the further direction of the stability of the interest rates will be decided on each particular meeting based on the assessment of the current data. I personally can reiterate the mantra I mentioned in some interviews I gave to the agencies. We smooth the inflation, not the interest rates. So interest rate is basically said it's an instrument we should use to smooth the inflation. And I think that was Otmar Issing who mentioned it in his article last year. Then in fact, if you would observe complete perfect monetary policy outcome would be relatively volatile interest rates and the inflation just flat at the same time. And if you would try to make the regression between the inflation and the interest rates, you would come to the conclusion that the monetary policy is not working because it's not efficient or it's not useful because the inflation is stable all over the time. And I think that's how it should like. So I can imagine that if we see the inflation pressures are really diminishing during the second half during the couple of months. We will see if we see that the interest rates exchange rate actually represents some some deviates from our forecast to the stronger side, and it's more anti-inflationary than we were expected, there can be discussion whether to compensate it by the decrease of interest rate. But this is something we will probably discuss only at the next meetings. And this meeting didn't really set the interest rate level for the next 6 months, only for this meeting. I think, is it clear? Thank you.
Next question is from Mrs. Horská.
Yeah, Helena Horská from Raiffeisen. Thank you for your presentation, and especially thank you for presenting here the exchange rate sensitive scenario. So I'm going to this part of your presentation. Maybe Vojta already mentioned the exchange rate development and the risk of such, would say, alternative scenario. So my question is how your opinion and voting is going to change if a fixed scenario, your sensitive scenario, will go into effect?
First of all, we are still in a blackout period when I am here to comment on a general consensus of the board, not to stress my personal opinions, my personal preferences. But of course, the scenario shows that if the currency will start to appreciate in line with sensitivity scenario, there would be a need to loosen the monetary policy in terms of cut-off interest rates. But I would be very cautious in judging this based on the 2 months data, because actually we experienced 2 years of currency underperforming our forecast and even the market forecast. So the corona was mostly weaker than you and us were expecting. So based on 2 months development, it would be very premature to make a strong judgment how we change the outlook and the view of the changing of fundamentals for the FX development in the future. So I personally cannot comment currently the specific sensitivity scenario, but the sensitivity scenario that was presented here itself, in fact, implies looser monetary policy in terms it's going to materialize.
Thank you.
Thank you. Next question.
Martin Po, General Investments. My question relates, let's say, the external sector assumptions and your perception of downside risk. You said it went down. What we can observe now is it's some probably temporary shock to global growth related to what is now happening in China. Probably it's only temporary, but we will see how deep and how long it lasts. But it has also many other implications. If you look at your technical assumption, let's say on oil, you have it quite substantially above the current level of oil prices. So when do you exactly fix your assumptions? Because your assumptions create downside risks to the current forecast part. If we compare it to the current market situation, and the board probably doesn't consider, let's say, the quite substantial expected slowdown of China and other economies as a significant factor for the global outlook.
The question on me are probably on Peter Král, because he is the responsible person for the
maybe
forecast.
If you could comment, how do you see the let's say risk related to the current slowdown in global growth, which happens in the first quarter?
I understand.
You don't see that relevant.
We understand. So I will let Peter Král to start, and then if it's necessary, I will add some additional points.
Thank you for the question. The cutoff date of the forecast, in terms of the input data, is approximately 2 weeks ago. So since everything that has happened since then couldn't be incorporated into the forecast. But I would like to maybe correct the wording you used. These are not technical assumptions. From the last year, we turned to the situation where our experts on foreign economic developments are more and more responsible for designing foreign outlook for those particular variables. That's why the foreign GDP growth and foreign PPI growth is, especially on the short-term horizon, fully in line with our experts think about the expected developments in the economic activity and price area. We have a battery of equations and other approaches providing us with some backcasting, nowcasting, and near-term forecasting. And as from some more distant part of the horizon, we, let's say, connect these near-term forecasts, our own near-term forecasting outlooks, with the consensus forecasts and other sources of medium-term outlooks, such as the IMF and other international institutions. The crude oil price outlook is still very much dependent on the market outlook, which was at those levels that entered our assumptions of the forecast, as I mentioned, approximately 2.5 weeks ago. So the decline in crude oil price in recent days is generating, other things being equal, some mild anti-inflationary risk to the current forecast, but simultaneously this can be easily counterbalanced by the fact that after the forecast was finalized, the ČEZ, the biggest Czech electricity producer, announced the actual price increases effective from March or April this year, which are somewhat above what we incorporated into the forecast. So the daily life is bringing all the time some new pieces of information, and now we have our fresh new forecast at our disposal, and the more proper assessment of the risks of this forecast will be the subject of the March monetary policy meeting of the board.
Let me add just a few points. I remember from my practice of the private analyst, there are three things I was always feared of. It's a prediction of euro-dollar, it's a prediction of gold prices and oil prices, and I would mention like a Spanish Inquisition as the fourth, and that's the impact of the political decisions of economic activity. So you never can win. And of course, we realize this, we take it into the assumption, it's one of the reasons that actually oil prices is assumed as an exemption from the inflation targeting. Of course, the bank board discounts the deviation of the oil prices from the baseline scenario from our decision about the interest rate setting. The second reason is also it's always problematic how to assess the impact into the economy. If there is an oil price shock, is it a supply side shock or is it a price shock? Is it like if you have a decrease of oil prices, which actually results in a negative or disinflationary contribution into the overall CPI index, but on the other hand, in fact, it represents a positive supply side shock, which in fact supports the economic activity and therefore also the inflationary pressures thereafter. So it's always difficult to assume these effects. And of course, we are modest in the sense that when we create our forecast and when we see the presentation of the forecast, some assumptions are already expired. But of course, that's how it is, because we cannot make our forecast on intraday data. And the second thing was, you mentioned the coronavirus, actually, and the problem with the epidemic in China. We follow it very cautiously because, of course, it can have temporary effect, it can have a long-term effect. As far as I know, the monetary department makes the analyzes it and compares it with the previous experiences with SARS and MERS, and the potential impact. Currently, it's very difficult to say how it's going to influence the global economy, Chinese economy, and Czech economy as a result. It can be temporary, it can be long-term or sustaining, which would be the worst-case scenario. But of course, even it can have broadly said, it can have a negative effect on the economic activity. But on the other hand, there is a problem. It can have a maybe inflationary effect on the global economy. So then you have the puzzle. How to approach to this, whether it's a reason for a tighter monetary policy because of the pro-inflationary impact from the import prices, or if it's anti-inflationary because of the negative activity impact. Is it clear?
Maybe just one detail. Could you elaborate what do you mean by the
just simply said,
inflationary effects?
We are most importer from Chinese goods. So we have a very extremely negative balance with China. Once you stop trading with China, the result is a lot of goods and investment products will be missing here. You have to replace it with something else. You will very unlikely replace it with cheaper ones. Is it clear now? And that's just a hypothetical approach, but definitely it will unlikely have an anti-inflationary effect on the Czech economy if it's going to sustain for a longer period. But we are only in the start of this, and let's hope that the Chinese government will tackle this issue and it will not have an extended impact on the global economy and the rest of this. Thank you.
The question from Mr. Broška.
Michal Broška, Komerční banka. I have a question on the forecast. Just to make it clear, you said that you expect some sharp recovery, and in fact, even for the first quarter, the expected recovery is pretty strong. It's quite, I think it's 0.8 Q-on-Q. So the question is why, and is that mainly the expected recovery in the foreign demand? And second question, what's your view on the position of the Czech economy within the cycle? Because in the second half of the last year, we saw some deceleration of growth, and you expect some more deceleration, 0.2, 0.3 Q-on-Q last quarter. And until recently, you were saying that the output gap was positive but closing. So, is there any change in this view? Thank you.
The previous year's government measures, increases in the minimum wage and extraordinary increases in old age pensions, led to the fact that Q-on-Q consumption growth in the first quarter of the previous year and in 2017 was above the trend. And the same can be expected for the first quarter of this year, because the groups of people who are affected by those extra money are those with extremely strong propensity to consumption. So the consumption growth will, in Q-on-Q dynamics, accelerate temporarily, just being fueled by these government measures. The other contribution is from the net export side, from the export side, and this is together with some carryover effect of inventories. So the acceleration of GDP in year-on-year terms is not sharp, I would say. After we have reached to slightly above 2% in the last quarter of last year, we can expect very similar year-on-year figures for the first half of this year. And for your second question, yes, the picture is pretty the same. Having seen the gradual deceleration of domestic GDP growth, we can now claim that the positive output gap has been getting narrower and narrower over time. 1 hour method used for identification of the cyclical position of the economy, which is the small-scale structural New Keynesian type of model, sees the situation as still somewhat positive, but a gradually narrowing or closing output gap, whereas the standard Cobb-Douglas production function it identifies the situation as the previously very open positive output gap has just closed. That was both questions.
Sorry. So, is there anybody with a question? It's time for the last. Yes, you can.
Petr Krpata, ING Bank. Just looking at your rate sensitivity scenario and the focus on FX, is it fair to say that maybe we can expect more of a volatility in the exchange rate setting in coming quarters? Because say if the euro Czech is staying close to 25, it may happen in May. The monetary policy department will be recommending a cut. Then you are dovish, you cut, exchange rate weakens. Maybe it's too weak versus the initial forecast. You may then have to hike in order to keep the inflation over the monetary policy horizon the same. And so that would be one thing. And second, I mean, this could be like more of the theoretical follow that policy recommendation scenario, but up until now, the board has been, I would say, adopting, cautious approach. The monetary policy department was recommending hike. The majority of the board was wait and see, looking at the data, and then eventually, after a certain time, adopted the recommendations. Could you envisage something similar, i.e. that you right now have almost or more than one cut showed for the second half of the year? If Corona is a little bit stronger, maybe there'll be more cuts. Can you mention this approach of being more cautious, whereby you'll be waiting with the cuts in the same way the whole board was waiting with the hikes previously?
I'll start with the
another
explanation of the exchange rate sensitivity scenario. Actually, the scenario was not prepared to illustrate the current exchange rate, let's say, uncertainty, or the fact that, on average, the exchange rate is 25.2 for the existing part of the quarter, compared to 25.3, which is the near-term forecast for the exchange rate. So until now, the deviation of the exchange rate from the baseline is very, very mild. And if we look back to the history, those deviations of the exchange rate was very frequent and didn't have much implications for any domestic variables. The sense and the purpose of the exchange rate scenario is to illustrate or to educate you, to show you that in the past the Corona was prevented by some fact from appreciating, despite the fact that that older CNB's forecasts were expecting quite sharp appreciation, and you were asking us what is behind such a sharp appreciation in the forecast when everything is unclear, uncertain, and that there is some Fed hiking rates and there is some rebalancing of portfolios of global investors and going from emerging market economies to the US. And we were asking ourselves whether really there is some missing factor in our exchange rate forecast helping us to explain this steadiness of the exchange rate. And we after switching to G3 plus model, we find a solution which is model consistent, and it really worked and really works. The corona in the last two forecasts was much more in line with the forecast. And we know that this phenomenon is temporary one, but will definitely not disappear, or most likely will not disappear suddenly and completely. That's why the baseline looks as it looks. But to show you how the curbing effect is actually here present, is the purpose of this scenario. So your initial statement that if corona is at 25, which is the current level, it would imply the interest rate cut is not a good explanation, or is not the good plot of the scenario. The scenario says if the interest rate differential and other fundamentals are again playing the same role they played in the older history, then there is a very huge appreciation on the exchange rate, big appreciation pressure that would potentially cause undershooting of the inflation on the inflation target, which would need some counter reaction of the central bank. This counter reaction of the central bank closing the existing interest rate differential would prevent the undershooting the target, and simultaneously would dampen the actual exchange rate development. That's why at the end of the day, after all this happened, the exchange rate is only mildly below the baseline, but not. This is not the other way around. The exchange rate is somewhat below the baseline. Then it implies this negative deviation of the interest rates from the baseline. So the story is completely different, and that's why we considered it very useful to present it here to get you some insight into the model mechanisms.
I will just add some points regarding the sensitivity of FX volatility for the consumer prices. Of course, there is a question whether it stays the same like 10 years ago or whether it changes. And each particular board member probably has his own opinion about the pass-through of the FX volatility into the consumer prices. I cannot comment today my personal view, but if you go through my articles and my interviews, you can imagine what's my attitude and how sensitive I am to the FX volatility, or how much or less. And when it comes to the sensitivity of monetary policy decisions to the FX volatility, it's very the same, because currently, in fact, we are not discussing very much about the current level of FX, of exchange rate. The problem of the issue of the Czech economy is completely different than the many Eurozone countries, because we were observing relative robust growth in the previous years. We are very likely beyond the business peak, the peak of the business cycle, but still we are facing tight labor market, unemployment fairly below the NAIRU or NAVRU, depends how you assess it, and still in fact generating relatively strong wage growth pressures. Of course, we expect it's going to moderate during the coming quarters, but still there is some persistence of the inflationary pressures stemming from domestic economy and resulting in demand-pulled inflation reflected in a core inflation below the target, but we have no target for the core inflation, of course, but below the 2%. And this is something we have to tackle with. This is something we have to, that was the main reason why the central bank decided to tighten further the monetary policy. And I don't think that the FX development would be the main trigger of the changes of monetary policy, but of course it's very important input into our mindset, into our thinking during and the debate during the meetings. But it's not, we are not dollarized economy when the prices changes every day based on the volatility of the FX like in other countries. There is very strong persistence, very long time when you see the exchange rate really being materialized and the consumer prices. So in fact, the sensitivity of temporary FX volatility should be moderate as well.
So the time is for the last question. Who would like to ask the last question? Yes, please.
I have a, Pavlína Žáková, European Commission representation in the Czech Republic. I have a question on fiscal policy, which is marginal maybe for you, but still you foresee a zero or even a negative fiscal stimulus in 2021, which is an election year. This is something that you probably don't factor in your forecast, but it's also the final phase of the implementation of the programming period 2014 to 20. Do you take this into account?
In the forecast, the mildly negligibly negative fiscal impulse for 2021 is as an outcome of some measures that virtually offset each other, but in balance they are very close to neutrality, and this is based on the current legislation and the current legal framework. If there is some fiscal expansion as we will be approaching the general election, this cannot be ruled out, but this is not a baseline scenario, and this is probably the question for board members concerning their views about this particular phenomenon. And as for the second question on the EU programs, yes, we are approaching the end of the current programming period, but during this period the rule of N+3 applies. That's why we can expect some increase in the effort of Czech authorities to spend all allocation from the EU funds only in 2022 and 2023, which is beyond the current forecast horizon. But something like what happened back in 2014, 2015 could be expected, maybe to a lesser extent than those times, but this will probably happen in the 2022 and 2023, which is, as I mentioned, still beyond the current forecasting horizon.
Thank you. And now, as Mr. Benda wants to finish our discussion with the last word.
Actually, it's not going to be really the last word, but you who know me, you know, usually liked this not to be a one-sided interrogation. So should be also the dialogue. So my question is on the audience, whoever wants to share with us what you see as the main risk for the economic development in this fiscal year and or the economic year, and which side and which would be the implication for the monetary policy. Thank you.
Jaromír Šindel, Citigroup. I was quite surprised by the relatively optimistic view on the recovery in the export growth. They do have relatively strong export activity since the first quarter and quarter-on-quarter terms. I'm talking about the year-on-year growth, but about the quarterly gains. And this, in my view, represents something like a downside risk to the economy, particularly if you look what is happening in the industrial and export sectors in, let's say, past few months. But frankly, I don't think it should be reflected in some lower policy rates. I'm happy we have higher policy rates, but its export activity seems to be quite optimistic from my perspective.
If I may also, I have the same opinion regarding maybe, in my view, very optimistic global outlook or Eurozone outlook. And I really don't expect some export recovery very soon, since we are in contact with our export association, and really there is really at least half of them are not really optimistic about the future, the near future. This is one thing. And second thing, in my view, of course, it's only my view, I think that CPI forecast for the first quarter of this year is a bit exaggerated, in my view, and I see this yesterday hike as a panic hike.
I will not comment on the yesterday's decision, but regarding the risks, I guess the fourth quarter in the Czech Republic in terms of GDP will not be nice. We will see next week. And of course, it's a past information, but it definitely is important for the carryover effect with respect to this year. That's one point. And secondly, definitely there is some coronavirus economics developing, and it's premature to figure it out, but it's here, and I guess it might have some effect, so it's another negative risk.
And Mr. Benda?
Just back to the coronavirus. Of course, people don't care that on a heart attack die much more people on the globe on a daily basis than on such a epidemic events. But we of course observe it very carefully, and the question is, what's the economic impact? Is it something that will really curb the economic activity over the year, or is it something that's going to curb economic activity 1 month and resulting in a higher growth the next month? That's what we observed several times, and this is something we don't know. Nobody of us don't know, because we are not doctors, we are not epidemic experts, and we can hardly predict what's going to be the impact on the Chinese economy for the rest of the world. And of course, that is something I remember when I was questioned as an analyst, was the impact of the explosion of the Iceland volcano. And what's going to be the impact? It's very difficult to observe it and judge it. And I thank you very much to all for your impact, for your comments and your views regarding the economic risks. We will see what will we experience in the real economic data in the coming months and quarters. I hope our forecast is correct, and you pessimists are wrong. And I hope it will turn, I'm pretty sure it will turn out that a hike was not, as you say, panic, but you were expecting a rate hike last year, right? Yeah, okay. I'm so surprised. And I'm pretty sure it will turn out that our decision was right, and whatever it takes, whatever comes, the monetary policy always is proactive and reacts on the current economic new data, and we are not locked up in our previous comments and previous decisions. That's how it should be. And what would be really bad for the central bank would be no action, waiting, generally approaching to the economy in wait-and-see mode and doing nothing and resigning on his mandate, which is fulfillment of and meeting the inflation target in the monetary policy horizon. Thank you.
Thank all of you for coming. Thanks for presentation, and I would like to see you again on 11th of May. Goodbye.